You are listening to The Vocal Technologist. Spoken Tech for your ears.
You know, if you're trying to keep up with financial technology right now, it feels like the game has just completely changed.
Oh, absolutely.
It's not this slow evolution anymore. It feels like the entire infrastructure got strapped to a rocket and someone finally hit the ignition switch. The speed is just, it's dizzying.
It is. And that convergence you're talking about is the key. You really can't look at one of these trends in isolation.
No, you can't.
The AI needs programmable money, which needs institutional custody, and, well, all of it eventually runs up against global regulation.
Exactly. So our mission today is to try and cut through some of that velocity for you. We've been looking at a stack of developments that really show where the money's moving and what the big power shifts are going to be.
It's a lot to unpack. We're focusing on three, I think, critical areas. First, this sudden, almost shocking explosion of autonomous software, what people are calling agentic AI in commerce.
Right.
Second, how digital assets, stablecoins in particular, are finally moving from being a crypto novelty to being core financial infrastructure.
And then the last piece.
And finally, this fierce global race for scale and how it's mashing up against the regulatory gatekeepers who decide who gets to play on the real payment rails.
Okay, so let's start with that autonomous software tsunami. Because we've all heard about AI recommending products, but this is something else entirely.
It's a whole different level. The data we've seen from Shopify is just, it's mind-blowing. AI-driven traffic to their merchants is up 7 times, which is big.
7 times, yeah, that's already huge.
But the truly shocking number is that the actual orders coming from those AI interactions have spiked 11 times.
11 times. Since January.
Since January.
I mean, that's a step function change in just a few months. What on earth is driving that kind of conversion rate?
It's the infrastructure. They built what they're calling a commerce for agents stack.
Okay, so break that down. What is an agent in this context?
Think of it as a piece of autonomous software. You give it an instruction, something complex, like buy me the best noise-canceling headphones under $300 and apply my loyalty discount.
And it just does it.
It executes every single step. And this new stack lets external models, like the ones in ChatGPT or Copilot, route the final purchase directly through ShopPay. The AI isn't just a suggestion engine anymore. It's your personal shopper and the checkout clerk all in one.
That's wild. And that's all customer-facing. But this same disruption is happening deep inside legacy finance, too. I'm thinking of Fiserv.
Fiserv is a perfect example of this internal overhaul. They've launched this huge initiative with IBM called Project Elevate. It's a 2-year plan.
And this isn't about flashy consumer apps. This is the plumbing.
Exactly. This is embedding AI deep into the back office, sales, client support, HR, even their Clover point-of-sale unit. The goal is just to build a higher quality, way more productive business by automating everything that's not a core task.
And the predictions for this kind of efficiency are pretty impressive. I saw a McKinsey number.
Yeah, they're massive. McKinsey thinks banks could see up to 20% cost reductions from really embedding AI across their operations.
20%.
But you have to pause there and ask, is that a long-term cost advantage, or is it just buying them time against the more nimble fintechs who were born this way?
That is a critical question. It really feels less like a permanent profit lift and more like just competitive necessity. You have to do it to stay in the game.
You have to.
Okay, so speaking of different approaches, let's talk about the Beacon software model. This is fascinating.
It is. It really raises questions about how capital is being used in this new AI era. So Beacon raised $250 million at $1 billion valuation, but their model is like the total opposite of traditional private equity.
They acquire a company roughly every 2 weeks.
Yeah.
In these overlooked sectors like youth sports software or manufacturing.
Right, and then they rebuild them using their own AI-powered tech stack.
Speed dating.
Well, the key thing is their focus on permanent ownership. They're not looking for a quick debt-fueled flip like a PE firm. They have this internal AI team that just strips out all the manual processes and automates operations. It's an AI-first roll-up strategy.
So all this speed, all this automation, it's impressive. But speed is useless if you don't have rails to run on. And that brings us right to the infrastructure wars.
Absolutely. As these AI agents demand instant programmable money, the underlying digital asset rails are being institutionalized faster than I think anyone expected.
And this is where stablecoins really come into the picture.
This is where they stop being just a crypto thing and start being core financial infrastructure. And the biggest move we're seeing here is from Coinbase. They're in late-stage talks to acquire the UK firm BVNK.
The stablecoin infrastructure farm.
Exactly, for about $2 billion.
Wow, $2 billion. That signals this is about way more than just a small client list. What's the real strategic play here?
It's about getting global remittance corridors and, crucially, banking licenses. BVNK isn't a simple trading platform. They do corporate remittance. So by buying them, Coinbase can immediately expand beyond its reliance on trading fees.
And offer what?
Offer serious, regulated merchant payments and stablecoin banking, especially outside the U.S. They're buying infrastructure, not just revenue.
It reminds me of that analogy from Stripe's co-founder, John Collison. He called stablecoins Starlink for money.
It's a perfect analogy. It just speaks to this borderless nature, bypassing all the old friction of correspondent banking.
And if we're talking rails, we have to talk security. Ripple just bought Palisade.
Right, a wallet as a service provider. And this is all about bolstering their institutional custody offering because, big institutions don't just need a standard wallet.
No, they needed to be bulletproof.
They need it to be absolutely bulletproof. And Palisade brings advanced MPC security.
MPC, that's multi-party computation.
Exactly. In, simple terms, it gets rid of the single point of failure of having one private key. You split the key into pieces held by different parties. It makes institutional custody way, way safer.
So while that's happening, the biggest legacy players are building their own kind of walled gardens with this tech. JP Morgan, for instance.
So they're absolutely using digital assets, but in a very controlled, proprietary way. They're tokenizing a private equity fund on their own blockchain.
Okay, so tokenization sounds very technical. For someone listening, what does that actually let them do that they couldn't before?
It's really about two things, liquidity and fractionalization. Private equity funds are notoriously illiquid. Tokenization lets you divide ownership of that fund into tiny digital units that can be moved and managed instantly. For a massive wealth manager, that is a huge leap in efficiency.
So institutional assets are being digitized for the wealthy, while at the same time, the masses are getting easier access to stablecoins on platforms like Revolut.
Precisely. Revolut is making a huge consumer play here. They're letting users convert between US dollars and stablecoins like USDC or USDT at a perfect one-to-one rate.
With no fees, right? Up to a pretty high limit.
Yeah, no fees on up to €500,000 every 30 days. That lack of friction is a massive deal, and it's a clear signal they're positioning themselves to maybe issue their own stablecoin down the road.
Which brings us perfectly to our third area, global scaling, and the very real friction you hit at regulatory borders. The tech's getting faster, but the rules are still defined by borders.
Definitely. And for scaling, you have to look at Pine Labs out of India. They're set to go public at about a $2.9 billion valuation.
Which is actually a big haircut from their last private round.
It is, but the number itself is actually less important than the strategy.
So what's the play? Is it just ambition?
It's more specific. It's leverage. India has built some of the most advanced digital public infrastructure in the world, like their UPI payment stack. Pine Labs is basically trying to export that specific expertise, that knowledge of building hyper-efficient, low-cost systems, and take it global to Southeast Asia, the Middle East, the U.S. That's their edge.
And that kind of expertise is clearly in demand. I mean, look at Airwallex. They just passed a $1 billion annualized revenue run rate. Doubled in about a year.
The demand is absolutely outpacing the old banking systems. But while these companies are racing across borders, the really fundamental structure of U.S. payments is being debated right here at home by the Fed.
This is the whole master accounts debate, and this is so critical to understand because it fundamentally changes who holds the power in the financial system.
It is a massive potential shift. The Fed is looking at granting certain qualified fintechs, Think Circle, Stripe, what they're calling skinny master accounts.
Okay, so a master account is basically direct access to the Fed's own checking account.
That's a good way to put it. It means these fintechs could access core payment systems like Fedwire without needing to rely on a sponsor bank as a middleman.
Which means they cut costs, they reduce their counterparty risk, and they essentially become regulated banks in all but name. Yeah.
That's it. It completely erodes a major revenue stream for those sponsor banks and pushes the U.S. toward a much more open payments model. But at the same time that's happening, we're seeing this counter move, this regulatory friction on the data side.
Right, the whole debate over who controls your financial data. A federal court just put a freeze on the CFPB's big data rights rule.
And that pause just reopens this entire debate. That rule was designed to basically enforce open banking in the U.S. to give you the right to take your data, your spending history, your account balances, and easily move it to a competitor.
And that right is now frozen.
It is. It's a major stall for U.S. open banking momentum.
And while all this is happening, you've got giants like Apple Pay just quietly, deliberately making these strategic moves into really complex markets like India's cross-border payment system. It's the game of millimeters.
It's the constant tension, innovation versus control.
So what does it all mean when we bring these three themes, the AI speed, the infrastructure adoption, and this regulatory friction back together?
I think what we're seeing is a fundamental redesign of finance, and it's all centered on autonomy. Agentic AI is creating this incredible speed and personalization.
Well, stablecoins are becoming the pipes.
They're becoming the standardized, high-speed infrastructure layer, and then regulation is deciding who gets to play on those rails, often keeping the old gatekeepers in power.
So the biggest tension is seeing these autonomous software agents making payments for us, driving that 11 times growth on Shopify at the exact same time that giants like JP Morgan are tokenizing assets inside their own proprietary walled-off blockchains.
That's the tension. The future is somehow both radically open and meticulously controlled.
Yeah.
And that tension between control and autonomy is the real theme here. So here's a final thought for you to chew on. If agentic AI is already driving 11 times more orders, and at the same time, your own control over your financial data is locked in regulatory limbo, what happens when the software making financial decisions for you knows more about your risk profile than you do? And who ultimately is accountable for that autonomous financial activity? Something to think about as you navigate what's coming next.
Spoken Tech for your ears.